Back in the spring, oil spiked past $119 a barrel, dragging inflation up with it and pushed mortgage rates higher. My guest today has good news. Oil just posted its biggest quarterly drop since 2020, and he says the worst is behind us. We're getting into exactly what that means for rates, why home values kept climbing anyway, and the three questions you can ask at any open house that could unlock a loan your buyer has no idea exists. Stay tuned. This episode of Keeping It Real is brought to you by Real Geeks. How many homes are you going to sell this year? Do you have the right tools? Is your website turning soft leads into interested buyers? Are you spending money on leads that aren't converting? Well, Real Geeks is your solution. Find out why agents across the country choose Real Geeks as their technology partner. Real Geeks was created by an agent for agents. They pride themselves on delivering a sales and marketing solution so that you can easily generate more business. Their agent websites are fast and built for lead conversion with a smooth search experience for your visitors. Real Geeks also includes an easy-to-use agent CRM. So once a lead signs up on your website, you can track their interest and have great follow-up conversations. Real Geeks is loaded with a ton of marketing tools to nurture your leads and increase brand awareness. Visit realgeeks.com/keepingitrealpod and find out why realtors come to Real Geeks to generate more business. Again, visit realgeeks.com/keepingitrealpod. And now, on to our show. Today's episode is brought to you by Corded.io. Are you looking for agents to join your brokerage or team? Now, as a real estate recruiter, I can tell you the answer is always yes. But most agents aren't looking to move right now. So how do you know who to contact? Well, what if I were to tell you there's a recruiting and retention tool powered by artificial intelligence that shows you exactly which agents in your local market are looking to leave their brokerage right now and which agents at your own firm are also looking to leave you. Now, I've been recruiting realtors for 15 years and I've hired over 2,000 agents. I can tell you with no exaggeration, this is the tool I've been waiting for. Corded's AI looks for trends across dozens of variables for each agent in your market and shows you which agents they believe are likely to move. Not only does it do that, but Corded's AI went and visited my recruiting website and read everything I offer. So now when I'm recruiting, Corded's AI tells me exactly what to say based on that agent's needs and what my brokerage can offer. It even writes emails for me. I've never seen anything like it, and I use it every single day. Now, if you are looking to grow your brokerage, Corded.io is the best tool out there. Visit Corded.io to schedule a demo. Again, that's Corded.io. And now, onto the show. Welcome to Keeping It Real, the largest podcast made by real estate agents and for real estate agents. My name is DJ Paris. I'm your guide and host through the show. And today is our monthly series called Learn with a Lender with Austin Clarence from Nexa Mortgage. So I am going to tell you all about Austin if you're new to our show. Austin Clarence is a top performing mortgage loan officer and investor financing specialist through Nexa Mortgage offering loans. He, by the way, Nexa is the largest mortgage brokerage platform in the United States, what basically means Austin has access to hundreds of lending institutions to allow him to pick the best product for your client. So he has actually close to 300 wholesale lenders nationwide, which is incredible. And he structures everything from conventional and FHA loans to advanced investor strategies, including DSCR, short-term rental financing, construction DSCR, and 15% down investment property programs. He can do it all. He is known for solving complex financial scenarios that traditional retail banks often decline. He works closely with real estate agents and investors to help them get more offers accepted, close more deals, and grow their real estate portfolios strategically. Through his Learn with a Lender segment here on Keeping It Real, he delivers practical, up-to-date lending insights that agents can immediately apply in today's market. And quick aside, we get a lot of really kind letters. We don't get letters. We get emails. We get messages sent on social media. Once in a while I get a letter, but rarely do. But I get a lot of messages from our listeners saying thank you for segments like this. Thank you for having Austin on. And they're so appreciative that we do this show and have all these different programs. One of the ways that you can help us obviously tell a friend, tell other agents about the show. But really, a very specific way that you could help us is if you are a practicing agent, you probably are, give us an opportunity to work with your next buyer who's doing financing, whether it's investment or primary residence. Reach out to him. Even if you already have a great relationship with a lender, get a backup offer. He would love to work with you. You can reach him at aclarence@nexalending.com. That's his email. We'll have a link to that in the show notes. You don't have to write it down. Also, he is available Instagram, TikTok, and YouTube, austin.mortgage. We'll also have links to that. Austin, welcome back to the show.
DJ, thanks so much for having me. Looking forward to another conversation. Appreciate you.
Me too. Appreciate you. And let's talk about it. So last time we were on, actually last couple times we've talked about this in different ways. And we were talked about how the mortgage world has been affected sort of indirectly by the Iran conflict, the Strait of Hormuz situation. And can you just sort of give us any sort of update on how that's continuing to affect or not affect lending rates?
For sure, DJ. And I know in a couple of episodes, we've already dove into the fact that 20% of the world's oil comes from Iran, specifically the Strait of Hormuz, that narrow gap that oil tankers are constantly coming in and out of. Normally it was hundreds per day. Now we have maybe a dozen or so per day. And this is the main reason why we have seen rates jump up almost three-quarters of an interest rate over the past 4 months. This has been the number one driver for all the inflation readings that we've seen that have really ticked up over the past couple of months. And therefore, our buyers are seeing this with their monthly payments. This is why interest rates have remained elevated because of the conflict of the war in Iran. As of the past week or so, we have seen a tentative peace deal in place, and we have seen the price of oil tank. I think before we were at right around about $120 for crude barrel. Now we're in, like, I think it was as of this morning, I saw when I was at the gym on the TV, $69 for a barrel of oil. So finally, we're seeing a little bit of relief at the gas pump. I literally saw it this morning when I was driving to the gym. Gas was at 365, and I had to double take because I swear it was 450 just a week ago. This is awesome to see. Eventually, we're going to see this funnel back into mortgage rates with lower inflation readings. This is definitely great news, DJ, and I'm excited for the next few months. I think we finally have had the worst behind us and now better days ahead and greener pastures.
So yeah, it's so interesting. I never had thought of connecting the price of oil or gasoline to lending rates, but apparently there's a correlation when the Strait of Hormuz is at least involved.
Exactly. Oil is really involved with everything, with trucking, shipping, manufacturing. It's not just filling up at the pump. It's everything that gets to the grocery store, everything that you're purchasing online, the Amazon driver. This impacts everything. So, with one of the main drivers of inflation being oil, now we're finally seeing very significant relief, almost half of where the price of a barrel of oil was just a month ago. This is eventually going to lead back into lower inflation readings. And over time, I think we're going to see the Fed start to channel this into their decision for eventually rate cuts and hopefully a smaller probability for now of actual rate hikes. So we'll see what happens here. This is definitely great news. I think the market really wants to see this stick. There's been so many on and off agreements with this conflict in Iran. I believe if we finally see an agreement stick, stay into place, and have the conflict really dilute and die down, I think we're going to see just better and better numbers for our buyers, lower interest rates. Of course, this is not what we're really trying to broadcast to our buyers. Oh, you might see lower mortgage rates for the next couple of months. Hopefully, there's more lower mortgage rates down the road. For some buyers, this could mean the opportunity of purchasing now with where rates are, having the opportunity to have really big refinance savings potentially when that time comes. So either way, this is great news. We'll see what happens here. I think the best way to describe what's happening, think of inflation like steering a cruise ship. Even after you turn that wheel, it takes time before that ship actually changes directions. So just because we're seeing oil prices tank now doesn't mean we're going to see rates collapse instantly. These inflation readings are really backlogged, typically about 30, 45 days. So now we're already in July. We're going to see that July data really at the end of September, at the end of August. So eventually this is going to lead to lower rates, just a matter of time. And I'm really excited to see it.
Yeah, me too. And I've been doing on I do a sort of daily walk and talk reel for social media where I talk about news of the day that realtors might find interesting and probably don't know because they're so busy working with their clients and running their business. And I've been talking a bit about the 21st Century Road to Housing Act, which I believe is still, so it passed the House and Senate, which is good. By the way, this bill would kind of reduce institutional investors' ability to gobble up as many houses as they have in previous years and incentivize sort of developers to start developing single family homes and other types of housing that we desperately need, which would be obviously very good for the for the country and also for realtors. And it's on the president's desk. I think it's within a 10-day window now. He can either veto it, he can approve it, or he can do nothing. And I think if he does nothing, it instantly becomes law. Don't quote me on that. I could be wrong. But anyway, it's very interesting. And I'm curious too, like if that passes, that may, who knows, that might be something that affects rates as well. If all of a sudden we see, ooh, more people are going to be getting into the game of building homes, perhaps that will affect things. Although I guess we don't know that for sure, but interesting. So we'll keep you posted on all of that. So let's talk about the Fed, because we have a new Fed chair. There's always talk about, from at least from current administration, Trump in particular, saying we need a cut, because of course that's good for him, certainly good for his popularity and good for good for lenders as well. But, or well, possibly good for lenders. They don't always follow the Fed's cuts, but he's got to get votes, the Fed chair, and we don't know that he's got that, and it doesn't seem to be, as far as I can tell, a rate cut coming this year. That could happen, I guess. But what do you think about where the Fed is headed, and what do you think agents should know about that?
Great question, DJ. And I think the reason we were just talking about oil there is because inflation and mortgage rates don't exist in a vacuum. So when oil shot up and essentially almost doubled over the course of a month and a half or so, transportation costs increased, businesses paid more, inflation picked up, and then the bond market and mortgage rates reacted to this. And this also played into the Fed policy. Right now, there's a lot of pressure on the new Fed Chair Warsh to get this right. He's going to have a big decision when the Fed meets on July 29th in the next meeting. Right now, the market is still projecting it's more likely to see rates higher at the end of the year than lower. So obviously, you can read between the lines. It's more likely we're going to see a rate hike before a rate cut, but those projections can change very quickly. All these economic reports that are being released every single day play into that decision. My personal projection is if we see oil prices stay where they're at and even keep dropping, if we see this peace deal come to fruition, I personally think it's more likely we'll see a rate cut before we see a rate hike. And I
Oh,
think eventually our buyers are going to see those payments drop if this deal sticks. That's a big if. I'm not making a bold prediction here because I can't predict wars, but I think if this deal sticks, oil prices drop, buyers' payments are going to drop with that, whether it be this late summer, this fall. It's just a matter of time. And I think the Fed will do the right thing at the time. And if we see inflation drop with this, right, we talked about steering that cruise ship, it takes time for this to happen. This is not going to show up in the CPI inflation report that's released in 2 weeks. It's probably going to show up in the one that's released in August. So everything's a little bit backlogged. I think eventually we're going to see better times ahead. And I think it's a matter of months.
wow, good. Well, that's exciting news, and always just a great reminder to our listeners. You do not have to be a specialist in where lending products are, how they correlate to things like world news or even domestic news with the Fed. And certainly it's not as simple as saying, well, the Fed raises or drops rates, lending um, it just follows. It doesn't always follow. In fact, the last two times I think the Fed cut rates, lending products did not follow suit. So it's not always that. But you don't have to know that. You just have to know that you have a great lending partner. And Austin would love the opportunity to chat with you if you don't already have one, or if you just want a second opinion, because he knows this stuff and he's so kind to come on our show. So let's talk about, what does all of this mean really for the housing market? We're talking about rates, we're talking about the Fed, conflict. How did home values actually do, in recent months?
Right? Because with rates jumping up three quarters of a rate, you kind of would expect a little bit of pullback, maybe zero appreciation. That's kind of what I think most people would guess what would happen when you see that shock injected into the economy that quickly. And it was really the opposite. I was reading the other day that Case Shiller released a new statistic that over the past 2 months, they've actually seen 1.5% appreciation over the past 2 months. And again, those were not two
Wow.
good months. Those are home buying season months, which generally is good on a seasonality basis. But with everything happening in the market, interest rates jumping up, if you can get any appreciation on a nationalized basis, of course, there's different markets that are going to see some modest depreciation, and some maybe jumped up 3-4% during the course of that 2 months. So this is obviously not going to fit every market, but it's great to see that on a national basis, that even with rates being elevated, we're still seeing appreciation. So what's going to happen if rates stay the same or come back down a little bit more? Probably going to see more appreciation, right? Because then numbers can make a little bit more sense for buyers. This is just a great reminder, great talking point for our buyers that, okay, I understand rates are not where you were hoping they were. Maybe your neighbor that you referred to, they did lock in that amazing interest rate 6 months ago when rates did temporary collapse. But you may have the opportunity, very likely at some point, to purchase now and have an opportunity to refinance to get that amazing interest rate after you've already locked in the house. Because if you're renting, you're not capitalizing on appreciation and you're still paying, of course, 100% interest with rent. Just knowing exactly what's happened in the past and having these data points to project to our buyers really is going to instill more confidence in you with them as your realtor expert. So better days ahead for appreciation. I think if we see rates come down, looking back the past couple months, the market has still been pretty solid.
Yeah, I try to remind our agents here at our company for help that agents that interest rates or lending rates rather are it really it's a fool's errand because the top economists in the country, including like Dr. Lawrence Yun, who's the chief economist for the National Association of Realtors, who I've been lucky enough to get to meet personally a few times, and he will tell you, he's like, yeah, I don't really know. I've got a lot of data. I've got more data than most people, but he makes a prediction, and sometimes it's accurate, and oftentimes it isn't, and it's not because he's dumb. It's just because that's how complicated all of this is. It's no different than trying to time the stock market. Is like, when should you buy? Well, when the stock's at its lowest point that we believe is going to, shoot up over time. But try to figure that out, and you'd be a genius if you got anywhere close to regularly accurate. And the best, financial managers in the country can't figure that out either, obviously. And so the idea of chasing rates is a really probably a poor strategy, or at least one to have your clients reconsider, because at the end of the day, they're not really dealing with a rate. They're dealing with a check that they write every month. And bottom line is, what's that number that they can be comfortable with writing? And for me personally, I gave up my not because I wanted to. I gave up that 3% rate because I was able to sell my place for a lot more than I would have if there were more homes on the market. And Austin's talking about values increasing, even just in the last month and a half. Yeah, Chicago is also it's outpacing the rest of the country, and in home values. And so for any of agents anywhere, if you're not running CMAs for your clients, hey, if you've lived in your home 5 years or 7 years even or longer, your home's made money almost certainly, not every case, but most cases. And you want people to know what their home is worth. And they're probably checking Zillow, looking at their Zestimate. And sometimes estimates are accurate, other times they're not. And as an opportunity for you with your experience to go in and say, I don't think Zillow's got this one right. Let me tell you what I think your home's worth. And do we really want to be out there looking to buy a home when there's all these other people that have jumped in to try to buy homes because rates have dropped? So for me, it made sense to sell my home at a premium, and there was fewer listings, and then take on a six. I think I'm at 6.5%, something like that, which hurts my soul, but I was able to make it work. And it's not a happy check I write every month, but it got me the place I wanted. And I think I saved like 80 grand on my place because there were fewer buyers. And again, I know that's an easy thing to say. It's hard to get somebody to take action on it, but I'm grateful I did that. And even though I'm paying more now, I won't always pay 6.5. And if I do, I can afford that, thankfully. But if the rates drop, I will refi if that makes sense. So I think that's always the conversation to have is what can you afford every month to pay? Let's figure out if we can get that to make sense. And the rate itself can always be a little bit of a misnomer because we just see a rate and high rates look bad and low rates look good, but we've all been conditioned now to see 3% and go like, that's where we should be. It's like, well, that was a really specific instance that hopefully is unlikely to happen because the only reason it happened was something very, very bad happened. And that's the only reason why we're all at 3% refis now. So let's keep that in mind. Sorry for going off on a little bit there, but I just wanted to give agents some ideas there of how to talk to people that say, rates are still a little high. It's like, let's just talk about the payment. But let's get into some of the specialty programs that our agents, our listeners don't know about. So let's find out. Give us some updates on what's going on. There are some new products that people should know and maybe could even use when they're talking to clients.
For sure, and I think in this day and age, there's literally never been more options to choose from than today's mortgage market, and this is not just like my company, this is not a selling point on what I can offer, it's really what's out there in the industry. It's truly amazing. There's so many more niche products and non-QM loans that banks and lenders are willing to hold the paper on as opposed to the standard conventional loan or the more common FHA loan or VA loan. There's so many niche programs out there and many of them are geared for people that work in specific fields. So, for example, a big program that's rolled out over the past couple of months that's become really popular on my side has been a doctor loan, where you don't have to have a down payment and you don't pay PMI. It's actually more forgiving if you have student loans than a conventional loan. It doesn't factor in as
Oh,
high of a percent into the debt to income ratio. This program's been an absolute hit since we rolled it out. So I think it's really great for you, the buyer's agents out there that are at open houses. If you meet someone and if you ask them a few questions about what they do for work, maybe they're a nurse. There's so many community DPA programs out there that can completely cover the full 3.5% down payment for an FHA loan if you are a nurse or if you are a police officer, a first responder. So asking those questions, being able to pick up when you meet somebody at an open house or at an event or a friend of a friend, or if you look them up on LinkedIn, maybe before that first consultation and you see what they do for work, you can find a way to incorporate that in. There may be a program out there that can help them with financing, get them closer towards getting the keys than they knew was actually out there. Because these are programs that are not really broadcasted on a commercialized basis. It's up to the loan officers to explain these programs to buyers and realtors for the education to occur. So I think in this day and age, there's so many great niche programs out there asking our buyers what they do for work. Are you a doctor or a nurse? Just waiting for that to come up. And there could be some sort of niche product offering that put them in a much better position financially with a loan as opposed to that standard conventional loan or, of course, just a standard FHA loan, whether it be the down payment or the way that loan is underwritten, PMI. There's so many great benefits depending on what you may do for work.
I love this. My marketing brain was going off because I've many friends who are physicians who I watched struggle through undergraduate and then med school and then residency and possibly fellowship. And these were the poorest people. They take on hundreds of thousands of dollars of student loan debt and also just being able to survive, loans just to live and pay their rent. And maybe one day there's a nice pot of gold waiting for them, 20 years later, maybe. But these are people that struggle and take on tremendous debt to become physicians. And we often just don't think about that. And if I was a practicing agent, what I might do, because I know this particular product talks a lot about people being in residency or fellowship. This is when they are at probably their poorest and they have tremendous loans. But while they're in residency or fellowship, some of those loans, and again, this isn't an absolute, but those can be actually sort of excluded from getting a loan. They're not factored in because I'm sure the lending institution looks at their future earning potential, looks at their stability in that profession, and for whatever reason, they're able to exclude that. So people who really have very little at most people who are in that stage of life who are becoming doctors, this is a great conversation to have. I might even call the medical schools that I am nearby and say, hey, there's this new program out that your students should know about because they may be able to purchase while they're finishing up school, going into residency, fellowship, etc. And I'm sure they don't know about this. So I see that as a huge opportunity. Get in with one of the medical schools, talk to the professors, say, hey, let's help your students. Maybe they can, start home ownership sooner because of products like this. And who knows, maybe they'll let you speak in their classes, or maybe at a function. So I think that's great. Also, going to hospitals, always great too. That's where residents and fellowship people are, as well as primary doctors who are out of that. So that's another great thing is you have friends who are nurses or in hospital administration, or just work in hospitals. Say, hey, there's this really cool product for doctors. I think most of them don't know about this. I would love to get in and see, maybe do a little lunch thing, and bring a lender like Austin, and he can come and talk to the doctors about that. So that's amazing. I'd never heard of that. So thank you for bringing that up. And also, if you want to hear more about that, just reach out to Austin. He can tell you more. Let's switch gears to veterans. So we talked about doctors. Now we know that there are products for veterans, but let's talk about people. Let's get our audience up to speed on what VA loans are, how they work.
Exactly. I think it's worth discussing, DJ, because so many buyers don't know. They may know of the VA loan, they don't know the benefits of the VA loan. So if our buyers don't know this, think about how many other people out there, they might be active military, they might be veterans, they're just not aware of these amazing benefits of the VA loan. So a quick summary, I'm sure most of you guys on the buyer side have represented a buyer who moved forward with a VA loan. It's similar to FHA. It's a government loan because it's more strict in a couple areas like the property shape, but in terms of every other component, credit score, down payment, debt to income ratio, it's so much more easy to qualify than any other loan. The credit score, I've done loans before down to 500 credit scores for veterans. Of course, they're still going to have some income. They're going to have to get approval through the lender's automated underwriting system, but you can actually go much higher debt to income wise than an FHA loan as well. For example, DJ, if you're purchasing a house with an FHA loan, every lender in the country is maxed at 56%. Some go a little bit lower that have an overlay. With a VA loan, there is no cap. So you can get approval at 60, 70%. If you have a strong credit score, maybe even a small down payment, it can go up to 70% debt to income ratio if you have residual income. There's so many little twists and turns with VA loans. It really takes years to master on the lending side to really be comfortable and confident with these loans. But having done many, there's insane unlimited benefits of the VA loan. They're absolutely awesome. Higher debt income. Of course, the biggest perk is there's zero down payment required with a VA loan. So it's kind of like down payment assistance, except you're getting a normal, awesome interest rate. VA loans have awesome interest rates. There's no PMI. There is a funding fee, but it can be waived if the veteran has a disability that's registered with the VA. So VA loans, again, the easiest loan to get approved for, and it's not particularly close. The benefits are awesome. Keep in mind, VA loans can be a jumbo loan. It can be the $3 million loan in Lincoln Park on that single family home, or it can be the single wide manufactured home, $160,000 in Northern Arizona with a 60% debt to income ratio that I closed the other week. So it can be any market. Don't think that just because I haven't dealt with a ton of veterans, I'm not near a military base. Eventually, you're probably going to work with some, and you're probably going to hear that the spouse has a wife or a husband, vice versa. That's a veteran, someone in the family is that they're purchasing with, and they could be eligible for the VA loan. So I think this is a great one to understand. Again, a lot of buyers really forget all these benefits exist. They might hear there's some good benefits. They don't know what it actually means, whether it could be lower interest rate or lower down. Really, it's a combination of all. It's a better interest rate and it's a zero down payment. And that's why VA loans are awesome, DJ.
I interviewed a realtor from Oahu, which is probably the island that most people would visit, where Honolulu is, and Waikiki Beach, and sort of like one of the main spots where people go to vacation. And she almost exclusively works with veterans because there's an active base there. And it was like really brilliant because they come over to Hawaii. They're, oftentimes still active duty, or they're nearing the end of their duty, and she's like, you don't have to rent, like we should set you up with one of these. And it is incredible. She says like nobody else understands these products as far as other agents. She said, all I have a there's always people coming and going from the base that are being deployed, or just getting shipped around. So she's like, there's always opportunity. And she said, they all talk to each other because they were working together. And she's like, it's the greatest thing ever. And this is her. And I can't remember if she herself was a veteran. I don't think she is. She may have been. So I apologize if I forgot that. But I'll try to find a link to that episode for those of you to hear. But this is an amazing niche. These are people that obviously deserve our guidance and help, and really don't get as much as you might think, because many agents just aren't aware of how these products work. So thank you for that. The no down payment obviously thing is amazing, and obviously an opportunity there. So that's really good. Okay, so let's talk about self-employed people, where a good chunk of our country is self-employed. So not veterans, not doctors, but self-employed people. I guess they could be veterans. But for people who are not veterans or doctors, but are self-employed, that always feels like a tougher loan to write. So tell us some ways in which, you think about self-employed people.
And I think everyone who's listening to this can probably relate in some capacity if you are self-employed or 1099. Either way, you've gone through the hurdles probably of the lender's requirements, of tax returns, showing your extension and profit and loss, and occasionally have to get your CPA involved depending on how those numbers look. It's kind of like opening up a can of worms when you're self-employed. It might feel like that when you go through the lending process. Fortunately, there's never been more self-employed buyers than ever in this day and age. You can actually get loans without having to show the tax returns and jump through all those hoops. So let's say you're really good at teaming up with your tax preparer or CPA, taking advantage of all those awesome write-offs out there. You can still get approved for a loan, not showing the numbers on the tax returns, because that lender is never going to ask for those tax returns. There's a program that was rolled out early this spring. It's a 3.5% down FHA loan. You just show a profit and loss statement without having to
Right.
show the 2 years worth of taxes. So as long as you're actively employed as of January 2024 to present, you've had the business up and running since then, you can literally make your own profit and loss. You don't have to spend money on having a CPA sign off on it, making sure everything's audited, sending in 10,000 documents to show invoices. They're going to take your word for it, which is awesome. It makes the documentation process a little bit easier. Again, this is an FHA loan with only 3.5%. Typically, bank statement loans, which again only look at the deposits going into your bank account, those typically require 15% down, 20%, maybe 10% if you're lucky. And you're going to have awesome credit reserves and a ton of compensating factors to make that work. This is really simple: 3.5% down, FHA loan. You make your own profit and loss statement. If you don't have one, you can make it a template, find a template online very easily and prepare one and purchase the house. So this is an awesome program for anyone who's self-employed. So you might find a buyer that you connect with, and they're actually waiting about 9 months or so to file their 2026 taxes. And who knows, maybe that tax return isn't going to show enough income. You're waiting for nothing. This can be a great program to tell your buyer to get some skin in the game, get in that market, maybe capitalize on some appreciation without having to wait in 9 months. Because who knows where you're going to be in 9 months? Are you going to have a strong enough credit score? Maybe you had a big ticket item expense on your car and your down payment cash is gone. This program is awesome because you don't have to wait. Again, this is another program that it's kind of a niche program offering, and you might work with a bank or a traditional lender, and they're going to tell that buyer they need to wait 7 months, 8 months, 12 months, whatever the requirement is. Again, that's the lender's requirement for a standard FHA loan or a standard conventional loan. But a lot of lenders don't even know this program exists, or they don't have access to. So that's why it's really good for all the buyers agents out there. If you have a buyer that's turned down, especially if they're self-employed, speaking with that lender and trying to understand why they were turned down. Don't let them rush you off the phone and explain that they have to wait this long. There's nothing you can do. Really understanding that, because oftentimes buyers can get discouraged when they're denied by one lender. They want to give up. That could be
Yeah.
giving up for a week, a month, maybe 2, 3 years. Maybe they'll never look into buying a house. because of that disappointing feeling of getting denied for that home loan. So speaking with that lender, knowing why they were turned down, what the requirement is, you can use that as information to get them with maybe another lender or a broker who can find a niche program offering that doesn't have those strict, stringent rules that an FHA loan will have or a conventional loan will have.
Yeah. Wow. Thank you so much for that. FHA is, I always feel that there are realtors that do a lot of it because they understand it, and then there's other agents that just don't know it and don't use it. And this is if you're not working with people who would qualify for FHA, you're really missing a massive subset of home buyers, because this is it. It's common as a brokerage. We have about 800 agents. We see FHA deals all the time, and I'm always so impressed by people putting 3.5% down and getting this amazing home that they want. So yeah, let's wrap it up. So when we've talked about a lot of things today, different loan products. We've talked about where the Fed decisions Fed might be making, as well as what's going on with the larger global conflict. And what what's one thing that our audience could walk away with uh, this week, so that they could take this into their business and have it impacted in a good way?
Going back to the beginning of this podcast, DJ, we talked about what's happening with rates. The good news, we're finally seeing inventory improving a little bit. Buyers finally have more choices, and sellers are finally negotiating again. This is creating a window where buyers can negotiate today and then potentially have an opportunity to refinance later. So if you're going in, you're getting a big seller credit for a 1.0 buy down or a 2.0 buy down to have massive payment relief during that first year or two. Again, they're not paying today's mortgage rates, or paying years past mortgage rates. So just knowing all these programs are out there. And yes, this is an opportunity to purchase today. You're going to lock in that home value essentially forever. And then you'll have an opportunity to capitalize on appreciation, because once home values go up, there's not going to be an opportunity to refinance to get the lower price. So there's
Right.
so many programs out there educating our buyers, reminding them it's about the payment, it's not about the rate. Let's focus on the bottom line, what actually matters. What can we control? We can control the negotiation. We can maybe get a little bit more aggressive. We can ask for closing costs to be covered. If rates happen to collapse in a few months, 6 months down the road, you're probably not going to have an opportunity to have closing costs covered. So I know you really want that amazing interest rate that your neighbor locked in 8 months ago at the 5.875 with no points. That ship sailed. But if there's an opportunity to refinance, you'll have that opportunity. But purchasing, when things do finally improve, as we saw, like you talked about before, DJ, in 2021, 2022, it was a frenzy. You're waiving contingencies, and you're definitely not going to get as much closing costs covered as you would in today's market. So just explaining what it would look like purchasing in today's market and what it would look like purchasing in this idealistic idea that a lot of buyers have for what it should look like to purchase. This will help keep them in line, remind them what opportunities look like in today's housing market.
One great episode, and lots to unpack there. So for our audience, we want to, as always, thank Austin for coming on, sharing what he knows about the lending world. And he is more than just a talking head on our podcast. He is an amazing lender. He knows his stuff, and he would love the opportunity to work with your buyers. So reach out to him, whether it's an investment, primary residence, any type of real estate transaction. He would love the opportunity to speak with you. You can reach him at email. His is aclarence@nextlending.com. Also follow him on Instagram, Facebook, everywhere, Instagram, Facebook, YouTube, TikTok. He is austin.mortgage, and we will have links to all that as well. And please give him an opportunity, reach out to him, get a backup offer, backup rate lock on your next transaction. And let's see how good. And remember, he's got almost 300 banks to shop it from. So I know I'm going to Austin for my next opportunity when I'm finally moving, because I want banks competing for me as well. So I love that. All right, Austin, on behalf of everyone, thank you, Austin. On behalf of Austin ourselves, thank you to the audience. Please tell a friend. Please reach out to Austin. Oh, by the way, Austin has a newsletter he drops every Wednesday, and you can get on that newsletter. It's really talking points for agents to be able to relay some of this information in a more digestible tone to your clients. So that's aclarence@nextlending.com. Asked to be put on his newsletter, and you'll get that sent to you every week. Austin, we will see you next month. Thank you.
DJ, thanks so much for having me on. Look forward to the next conversation. See you guys. Thank you.